So are you saying that the sort of on a stealth way, the government actually wants the price of gold to rise versus the dollar?
Yes, I do believe that. It is the only way you will ever be able to reshore manufacturing is to devalue the dollar. When Roosevelt devalued the dollar or confiscated gold at $20 an ounce, he then devalued the dollar by 40%, making it $35
And he
an ounce.
had to do the confiscation before he revalued. A different thing this time around. Yeah.
Correct. And I really do believe that is what they want to do. Now, is there an arrangement for the Treasury to buy that gold? I don't know.
Just start with this screenshot that I just grabbed a couple of minutes ago. We see that gold here is fighting its gold futures are fighting their way back up to 4,200, up $66 an ounce so far today. And silver, not to be outdone, is up almost 4% today, back up strongly over 52 bucks an ounce. Who knows, maybe 53 bucks an ounce by the end of the day. Again, folks, those are futures prices. But Andy, is the rally back on?
You know, I think that there are a lot of things at play when they knocked it down. The answer is yes, but I think you have to examine what happened when they knocked it down. I mean, it got knocked down in 2 days. You saw in both instances, a couple weeks ago, you saw massive amounts of gold and silver dropped in what's called the access market. It started anyway at a period of time in between New York closing and Asia opening. There's no liquidity in the market there. And when this happens, it would be the worst possible time to ever do it. In fact, there wouldn't be a trader on the planet that would ever do it. If they did, they would be fired and shot, and probably not in that order, as you're dumping copious amounts of gold and silver onto the market when the New York traders are gone for the day and there is no liquidity in the marketplace. And it hits stops because there's no one there to fill the order, so it just triggers stops all the way down. It's a drive-by shooting. The interesting part about it was that Michael Lynch, I believe is his name, I think that's his name, an analyst who talks about the COMEX, says, you know, there was interesting movement when the price got slammed down. Two American commercial banks came in and bought massive amounts. It was Bank of America and Morgan Stanley. They came in and literally silver went right back up, and gold came up about halfway because it had hit so many stops on the way down, where funds that use algorithms to, you know, trigger sell limits or sell orders just fall. But the interesting part about Morgan Stanley and Bank of America is you have the chief investment officer, of course, of Morgan Stanley, it's well known now, that said sell half your bonds and put 20% of your assets in gold. And then Bank of America lead analyst Michael Hartnett is saying, yeah, make that 25% in gold. And so these two banks came in and gobbled it up. But when you look at how this has tremendous strength and resiliency, I look back over my career, Adam, and any time that the market got hit this hard, they'd step on its neck and it would never come back. You know, everyone was saying, this is it, it's over. Gold broke 4,000, silver broke 50, the bull run is over, sell your gold. It never left, and it was done. If when the media said that, they said, by the way, the start of this massive sale happened when no rational trader would have ever done it. It was dumped in the middle of the night when there was no liquidity. This would have been done over hours or days during New York trading, not bang when there's no one there. If they would have said that, I think the market may have looked at things a little bit differently. Oh, I see. And then two big U.S. commercial banks who have changed their allocation recommendation to gold came in and scooped up physical on the cheap. There are a lot of games going on, bottom line. And I think you just have to have strong fingertips and see the bigger picture.
In 2 sharp days, the market for gold and silver witnessed what can only be described as an engineered collapse, a drive-by shooting of metal into a thin market, triggering algorithmic stop-loss orders and a cascade downward. No trader acting in rational risk management would unload huge positions when the market is least liquid. Yet that happened. Then, 2 major U.S. commercial banks swooped in and reloaded. Bank of America and Morgan Stanley reportedly buying heavy amounts of both metals. The orchestrated nature of the dump, followed by strategic accumulation, suggests a deeper institutional game at work.
I guess it could have been both. It looked as though the banks involved were European banks and Scotiabank were the ones that sold. And drive it down. Look, there are problems where these banks have very large short positions and they're exposed. And a silver market that gained nearly 40% in 2 months, to your point, a correction was inevitable. That is the definition of overbought. But I think there are a lot of banks and a lot of big players who were off sides in a very big way. And you could argue it was dumping in order to cover short positions and an opportunity for other banks. I don't know. All I can tell you is that there is no rational explanation to dump it at a period of time when there's no liquidity in the market. You would do it judiciously, slowly in New York trading. And again, to your point, it's also important to remember that even with this sharp correction, when you talk about silver, it's up over 65% this year. And gold is up over 50% this year, even with these pullbacks. But to me, it's not even as much who or why as it is what. Why would anyone do that? There's just no possible explanation for why anyone would dump it at a period of time to trigger all of the selling. It's a drive-by shooting. It's done for effect. Maybe it was rescuing stale short positions for one entity or an opportunity for others. But the bigger question is, why even do it to begin with? It would be the least opportune way to maximize this massive gain that you would have had if you're selling, unless that's not what it was.
This accumulation isn't select. It's broad and deep. Central banks recorded 39 tons of net gold purchases in September, a nearly 80% month-on-month increase and the strongest monthly figure of 2025 so far. Stablecoin issuer Tether revealed nearly $13 billion in gold holdings on its latest balance sheet, backing digital tokens with precious metal assets. Premiums on U.S. mint bullion coins have surged, gold buffaloes trading $300 over spot, silver eagles $8-9 above. The physical market is tightening, just as demand from sovereign and institutional buyers transforms the narrative of gold and silver from speculative to strategic.
I mean, when you talk about at the institutional level, I would argue that you're running into serious supply constraints. I mean, you look at the central banks and their numbers are usually backed up a little bit, but in September, they bought 39 tons of gold, which was up 79% month over month. And it's the highest month of reported net buying in 2025 so far. And you're continuing to see massive amounts of gold bought across the board. You look at Tether. Now, I've talked a lot about Tether and their role in the stablecoin legislation and how they are buying gold and Bitcoin with their profit. Their numbers on their third quarter balance sheet are almost 13 billion in gold. They're buying gold hand over fist. Wow. When they issued these stablecoins, to back whatever it is that they're doing, they're backed by U.S. Treasuries, and the interest on those treasuries is not transferable moving forward. And they will put more and more into gold. They were just at the Beaver Creek Mining Summit. So they're dealing directly with the miners now as well. And so I think whether you're talking Tether or the central banks or the massive deliveries into COMEX or the massive deliveries in Shanghai, at the highest level, you're seeing a quiet rush for physical possession, huge amounts. And I don't know, I just think that this inventory problem will only get worse. Now, it's ironic that we haven't seen it as much on the retail level, but we're beginning to in certain areas. And I don't know if there's any coincidence or just it's the inefficiency of the U.S. Mint, but the U.S. Mint, the product availability is horrid and the premiums are out of control. Right now on gold buffaloes, you're going to pay about $300 over spot to buy a gold buffalo. They're as rare as hen's teeth all of a sudden. American Eagles, $200 over. Silver Eagles, $7 or $8 or $9 over. I mean, the premiums are all of a sudden on U.S. Mint products. They haven't made a Platinum Eagle in years. As a side note to all of this, you want to kind of draw a line between conspiracy and reality. I would urge everyone to go to Road to Ruda's website or to YouTube channel, Big Swear, and watch his 3-part series with a man named Jack Sermon, which was done a couple of years ago. I remember almost falling off my chair hearing it. Jack is the guy that developed the Eagle program for the U.S. Mint, and under Janet Yellen, he said he was told by his superiors, who would have been Janet Yellen, the head of the Treasury, to only mint as many silver eagles, the fewest amount possible, without creating a global revolt. He admits this, and he's been at the mint since '86, since they started doing it. There's no question that the U.S. Mint is by far the hardest mint to get product from reliably, in my opinion, at a reasonable price. But I wonder, is it starting to spill down into this side of the market, because you're beginning to see people wake up, not the thousands of sales, everyone buying, tiny little bits, but on high levels, we're seeing very, very, very large orders, and a lot of it in gold. What does it mean? I'm not quite sure, but simply to say, at the top, it's not getting any better. Is it starting to trickle down? Yeah, maybe it is, but it hasn't reached Main Street yet.
What if the rising gold price isn't just about protection, but policy? Some analysts argue that the U.S. and other governments may view gold's climb as a mechanism to support weaker currencies and reshore manufacturing. A devalued dollar makes exports more competitive. In this scenario, digital tokens backed by treasuries and gold become tools of financial engineering. And when production returns home at low cost, the endgame is a transformation of the financial industrial base. Gold, for decades framed as pet rock, may actually be central to the next monetary reset, whether publicly acknowledged or not.
Yeah, and I'm going to talk about something else also. Now, again, maybe I've been stupid to say things, or maybe I'm just courageous enough to say what I believe. I don't know. There's a fine line between that and that. But, there is a fine line between conspiracy and reality, and I've learned that the hard way over the years. Now, Bo Hines was Trump's crypto czar until August, and now he just happens to be the CEO of USA Tether, which is already Genius Act compliant. Mm-hmm. Now, if you wanted, as I've been saying for a long time, to bring back manufacturing, the only way to do it, because of Triffin's dilemma, is to shed the reserve status and devalue the dollar. Everyone's talking about the debasement trade. Even mainstream is talking about the debasing of the dollar. Well, the way to do that is to revalue gold. So what if he says to Bo, all right, Bo, with all of the interest that you get, you're going to buy Bitcoin, you're going to buy gold. You're going to use Bitcoin to pay off the debt. You're going to buy gold to devalue the dollar. You have a major player now who will be moving every time money moves, and the backing of it by stablecoins has to be bought by U.S. Treasury. That's the one-to-one peg. It's the treasuries, and dollars, but it is the interest that is not transferable on those treasuries. It can't. Mm-hmm. They're not giving the stablecoin holder the interest. Instead,
they're buying with that interest, so they're buying gold.
The charts tell a vivid story: a metal setup for explosive ascent, yet also vulnerable to abrupt correction. Gold's recent surge, over 50% this year even after the pullback, followed by a steep drop, mirrors classic parabolic cycles. Precious metals may run up swiftly in the right environment: risk aversion, flight to safety, liquidity dumping. But when many chase the same momentum, the exit can be abrupt. Not every move will be smooth. Investors should expect volatility, sharp gains, and sharp reversals. For those considering entry, timing and conviction matter more than ever.
Because the higher the price of gold goes, the lower the value of the dollar. So in other words, when you measure the dollar falling 7 or 8% against a basket of crappy currencies this year, the dollar index, measure it against gold and see where it is. It's down 50.
So let me just interrupt you then. So are you saying that the sort of on a stealth way, the government actually wants the price of gold to rise versus the dollar?
Yes, I do believe that. It is the only way you will ever be able to reshore manufacturing, is to devalue the dollar. When Roosevelt devalued the dollar or confiscated gold at $20 an ounce, he then devalued the dollar by 40%, making it $35.
And he had to do the confiscation before he revalued. A different thing this time around. Yeah.
Correct. And I really do believe that is what they want to do. Now, is there an arrangement for the Treasury to buy that gold? I don't know. It wouldn't surprise me when you put Bo Hines in there. It's no different than putting Stephen Mirren in the Fed, who is the architect of the Mar-a-Lago Accord, which again speaks to a devalued dollar. And you talk about gold revaluation, it's not a conspiracy theory. I mean, read the Genius Act. I think Section 9 or Section 10 talks about next year they'll revalue gold. Now, some say market to market. James Rickards is going around saying, I think he says 24,000 is the number he comes up with. We don't know what that number is, but raising gold to that level not only devalues the dollar substantially, but gives the Treasury General account a huge boost of free money that would come in the form of selling or giving the gold certificates to the Fed, and they just print money out of thin air and give it to the Treasury. We can go into how that works if you want, but the bottom line is it devalues the dollar. It gives a large sum of money to the Treasury that can work down its debt. And then you throw in Judy Shelton pegging the back end of the bond market. You bring back manufacturing at no upfront borrowing costs. Is it the way to do it? I don't know any other way besides full-on default or hyperinflation. This is kind of a third option, soft default on the dollar.
Okay.
And, but one last thing, you look at, I'm going to butcher the name of this, Kyrgyzstan. Yeah, their government has just officially registered a U.S. dollar, it's USDKG, as a stable coin, pegged 1-to-1 to the dollar and fully backed by gold reserves under state control. And so we're seeing gold move into the monetary system. And that's the bottom line. Whether the central banks, the commercial banks, the massive deliveries into COMEX, these people that are bringing in billions upon billions upon billions upon billions every month for the last year, since last November, they don't do this just for the hell of it. And as you've noticed, since all of this gold's been coming into the country, isn't it interesting to see that gold is up 50 plus, 60%? Right. They don't do it just for the heck of it.
We stand at a crossroads. The global economy, awash in debt, dependency on cheap money, and speculative risk may be heading toward a major recalibration. Gold's rally isn't happening in isolation. It's participating in the story of fiat money's decline. If equities crack, credit stress returns, or tech bubbles unwind, metal may become the haven of last resort. Whether we call it monetization, stealth devaluation, or structural reset, one thing is certain. The rules of wealth, money, and value are shifting. For those watching closely, the question isn't, will something happen? It's, are you positioned for when it does?